everybody, it's Nick Jevic. You may recall in the first video I talked about how I was getting phone calls and emails from people looking to issue something called debt equity, and I didn't know what that meant. But through phone calls and emails realized that what people were looking to do was to issue debt with an equity kicker. And then we went and talked a little bit how that's done through an instrument called Warrants. Then we went to Excel, and I showed you how to build a real simple little Excel spreadsheet to calculate how much those warrants need to be worth. So really how much of the equity you need to be able to provide to your investors to hit a certain internal rate of return. So in our example, we had a $2 million loan, we had amortization over 5 years, we had a 12% coupon, and then we were targeting a 21% IRR. And then when we did the math, it came up to about $1 million in equity that you need to be able to provide to your investors to hit that 21% IRR. Now that $1 million represents some percent of your equity, and that's what we're going to talk about today. So let's go to Excel and we'll tie it all together for you. Thanks.
Okay, here we are. We're back at the Excel spreadsheet that we put together last week. And just to recap, we've got a deal that is $2 million note offering. We've got a coupon of 12%. We've got some amortization that we've highlighted down here. And we're targeting a 21% internal rate of return. And then I showed you how, by using the goal seek function of Excel, we were able to figure out that to achieve that 21% internal rate of return, we needed $995,000 of equity represented by the warrants to get that deal done. So now that we know that, we need to figure out what that represents in terms of the equity value of the business. So what you'll need to do is put together a forecast for your business and figure out what your base case EBITDA is in year 5. And so I've done that here for our example. And in this situation, I've got just over $3 million of EBITDA. The business here we're assuming is valued at 5 times cash flow, and that gives me an enterprise value of just over $15 million. Now to get to my equity value, I need to take that enterprise value, subtract off my debt, and in my model I had $1.4 million of debt outstanding at the end of year 5, back off any preferred, and I had none, and then add any cash that's on the balance sheet. And just to be clear, this is really unrestricted cash. So if you have any cash that's restricted for some reason, you will not want to add that back to the for this valuation purpose. And so doing that math gets you to an equity value of $13,861,000. So we know from the spreadsheet here that the equity that we needed was $995,000. So dividing that by the equity value gives me a percent of equity of 7.18%, and I'm going to round that up to 7.2%. Now to express that in your term sheet and in your offering memorandum, in terms of the number of shares that the investor will receive, I'm going to assume that we've got 10,000 shares outstanding. We've got 720 warrant shares, which is 7.2% of 10,000. My minimum subscription in this example is $25,000, so that's the minimum amount that I'm going to want an investor to invest in this deal. And so that means that the warrant shares per note is 9. And so the way I come up with that is taking my note offering of $2 million, dividing it by the minimum subscription amount of $25,000, which means that I'll have 80 notes, dividing the 720 shares or warrant shares by 80 gets me to the 9 warrant shares per note. So that's it. I hope that helps, and hope that helps clear up how you go ahead and structure and put together a debt offering with warrants. If you want a copy of this spreadsheet, I'm happy to provide it to you. Just send me an email. Just go to my Contact Us page, and I'm happy to, again, send that to you. And we'll look forward to seeing you on the next video. This is Nick Jevic. Take care.